You are listening to the ESG and Coffee podcast on investing, strategy, and sustainability, hosted by Graham Sinclair.
Are very late, and solving for economically rational prices isn't enough. Right. Yeah. And that we really need to think that if there's a small probability of a very catastrophic set of events, right, then the present value of that has got to be thought of as insurance. Yeah. A small chance that your house will burn down provokes right, all kinds of precautions. And so from our perspective, I think the unseen complicity that we are all guilty of, it can only be addressed if that price is really quite high and quite remarkable. People are your comparative advantage most of the time. Execution risk is what's governing this. Take large segments of the developed markets in finance and financials, software, healthcare, travel, tourism, leisure, take entire swaths of the economy, and people are making the difference. And so there I wanted to point out that it isn't by cutting down on the costs of the people, but that their productivity, imagination, and execution would actually widen your ability to grow the pie and make it better.
I'm so pleased today to bring you the interview with Geeta Aiyer. She's CEO and founder of Boston Common Asset Management, her own shop, which she started up in Boston area in 2002, having moved away from a very successful investing career, but deciding she really wanted to build an investment shop with ESG integrated in the core of what they do from the beginning, not as an extra or as an add-on. She's gone on to build that shop very nicely. She's now got some new equity ownership, which is helping them scale up their business. They have around $4 billion in assets under management right now in 2021. I appreciate her candor. Yeah, she's very clear that they're a smaller shop, but what she hopes they can do is to catalyze other investors in looking at significant sustainability issues and finding ways forward to helping improve things and taking a very integrated and connected and global view of how things are and how one can't just segment or silo issues from this place to that, but really how all things are really connected and how the economy works. You'll hear also from her because she is the portfolio manager of the US large cap value strategy. You'll hear some of the technical challenges she has to face as a value investor, how she has to make the case for that even over the last 7, 8, 9 years where value has really underperformed as a strategy for active investors. You also hear some candid points of view from Geeta on where she sees the relative value of passive investing or tracking an index looking backwards versus having an active manager making bets looking forward and pulling forward the projected performance of a company. We also have a lot of fun. You'll find out her favorite pie is an apple pie. And you'll also hear me encouraging her, maybe nudging her over the line in terms of finally getting out her own book with such a rich history of her career thus far and what she's looked to do. It sounds very close to her having something of a manuscript almost ready to go. I'll put in the show notes any updates that we have on that. So please enjoy my interview with Geeta Aiyer, CEO and founder of Boston Common Asset Management. And as always, a reminder, ESG and Coffee is not investment advice or selling. Do your own research. ESG and Coffee is here for you to see the world of investment and the business of investment through the eyes of the ESG architect. Please enjoy. In this episode in Season 1, I am pleased to welcome to the ESG and Coffee podcast one of the originals making ESG positive investment happen, Geeta Aiyer, CFA, President and Founder at Boston Common Asset Management. You can learn more about Geeta on LinkedIn. She is absent from Twitter, as far as I can tell. But LinkedIn describes her as having specialties in sustainable investing in search of financial return and social change. Welcome, Geeta Aiyer.
Thank you.
Where in the world are you today, Geeta?
I am in Cambridge, Massachusetts. We are working remotely. The office is in Boston, but I'm in Cambridge. I'm also in a state of happiness because I got my first vaccination shot last week.
Wonderful.
So
Oh,
I'm
that's
on a
wonderful.
new journey at this point.
Excellent. Oh, that's great to hear. So first up, if we were meeting at your local friendly cafe or coffee shop or what have you, what would I be ordering you from the counter?
Oh, something very basic like a breakfast blend or Colombian, but no milk, no sugar, no substitutes, just
Okay,
plain coffee.
nice. I like it. And you have your cup of coffee with you now. I know I have mine, yeah? Cheers.
I do. Mhm. Cheers.
Right, let's kick off then. At the beginning, I like to start at the beginning by looking back. In Sir David Attenborough's superb Netflix documentary, Our Planet, did you have a chance to look at that, by the way? Have you seen it? Yeah.
I have, yeah.
He references two significant data points which illustrate the exponential changes in our planet in his lifetime. They kind of stuck with me. So I went ahead and asked you ahead of the interview to get those two data points for yourself and then one other. So let me ask the question and then I'll let you answer. In the year you earned your first career paycheck, you don't have to tell us when that was or how much it was. Roughly how much was each data point? So world population?
About 4.5 billion
Okay.
that at that time.
Okay. And the level of the S&P 500?
128. Hard to believe.
Oh, concentration of carbon dioxide parts per million in the air.
338.
Wow.
So, yeah.
So for reference to the audience, the population right now is around 7.9 billion. S&P 500 is around 3,800, 900, somewhere around there. And CO2 equivalent is 416 parts per million.
Amazing.
So how does it feel, Geeta, to hear those numbers or to research that and come back and have a look at it?
Yeah. On the one hand, I feel a sense of possibility. And on the other hand, of course, I feel huge concern. And the possibility stems from the fact that we've conquered so much. We've substantially cut childhood mortality, maternal mortality, infant mortality, disease. We've improved public health. We've increased longevity. So all those are apparent in the population numbers, for example. Widespread and easy availability for intentional parenthood is an important element of that. Continuing education of women. So the way I look at it, the feedback loop has yet to happen. We've seen the possibility explode the numbers, and I'm an optimist enough, and this is where I see possibility that we are on the path to that feedback loop coming back to us, and that we will actually address this. And so, continued education of women, continued advancement of public health, continued confidence in having a planned and intentional family. All of these will continue to will improve.
Mm.
I guess on the other two numbers, I see a dominance of a model of what it means to be well off, and what matters, what counts, what it means to be rich, what the rich do, and there is a converging vision of what that is. And so, to me, the optimism has to come from other models being resuscitated and given validity, and a questioning of these orthodox models on which the convergence is happening. Earth doesn't have the resources to sustain those aspirations for all.
Right. Yeah, thank you very much. And we'll touch on some more of those when you do the deep dive.
Yeah.
In particular, the speech you gave around the Joan Bavaria Award, I want to come back to pick up on some of those themes. So thank you. So let's change it up with a change of pace now very quickly, jumping into 5 fast espresso shot questions. We try and keep things lively as much as we can. Are you ready?
Okay, I am.
There we go. Question 1, and just very short, 30 seconds or less. What is your earliest memory of investing?
Believe it or not, it was with the South Africa divestment movement. I had never been in investments at all. My first job in a consulting firm was to write about uh, South Africa divestment.
Okay.
I didn't know I would be in finance at the time.
Wow. Okay,
Mhm.
great. Were you in the US at the time, or were you elsewhere?
I was. I was in the US. I'd finished my MBA and gotten my first job at the time.
Okay, great.
Yeah.
Question 2, what is your philosophy of investing in one sentence?
Long term and preserving capital and enabling it to grow. Um,
Okay, good. And what switched you on to ESG for the first time?
it was the combination of assumptions on which the South African divestment was based. The idea that means mattered, and that to enjoy returns, you needed to feel that it was justifiably obtained. And it brought a framing into finance that went beyond numbers and really touched a chord within me.
Hmm.
I had been a rather tools and mechanics and numbers driven investor up to that point.
Yeah. And for myself, I completely empathize with that moment, because I can literally picture myself hearing the first presentation. I was on the 8th floor of a building overlooking the harbor of Durban, South Africa, and we're being pitched an investment by a team called Future Growth on investing pension fund money, and that money would be invested in areas that suffered because of the Group Areas Act in South Africa, so underinvested areas. And for the first time, someone was making the case you can make money and you can help grow communities in new and better ways. And I can literally picture myself in that moment. So as the way you described it reminded me of that moment. Good. And then how do you choose to define sustainable investment or investing with ESG factors in less than 30 words?
Again, I go back to investing for the long term and building capital that not only is drawn from sources that you can feel proud of, but also that can sustain a world in which that capital can be enjoyed.
Hmm.
And from my point of view, that is what sustainability is all about. And we may be too late to be calling it sustainability. We should be calling it regenerative at this point. We've gone past those points of sustainable investing.
Okay. And last of the first 5 espresso shot question, what is your biggest investing mistake so far?
My biggest investing mistake is to hold on too long to some of the energy companies. And I'm happy. I look back and think that there was a combination of things that led me to hold on to them much longer than I should have.
Okay. And I think that's a topic we'll pick up also a bit later in the deep dive.
Yeah.
Thank you. Great. Okay. So let's start the first of those first of 3 deep dives. First of all, to acknowledge, in the first series of ESG and Coffee podcasts, we're dealing with the originals. You are absolutely one of the originals. You founded Boston Common Asset Management in 2002, but you'd already done work before then. You're the first founder I've done an interview with. So how does it feel like to be a founder?
It's very liberating, but it also puts a lot of responsibility on you. And for me, it was an opportunity to see if my ideas could be vindicated, and it was a test of whether those ideas could be sustained. So I left a good job to start a firm. This was the second time doing the same thing. I had this idea that you shouldn't retrofit ESG and sustainability into a regularly optimized portfolio like an afterthought, and that you should start from whole cloth looking for opportunities for a sustainable investor. There was that. And then there was the idea that engagement and global thinking and kind of seeing the full picture was very much about what investing is. Because one of the ways we hide is that we segment the world, or we kind of say this is for someone else to look out for.
Right.
And in time and place, and in global background, just from having lived overseas and grown up overseas, I knew that this was not a good way to be, not a complete way to be thinking. So all of integrating of ESG has been for me about rounding out and completing finance, which was one of those ambitious things that you say when you're young and rather daring, which is that we were here to transform finance and awaken it from its enforced self-censorship and kind of wearing blinders when they didn't have to, and really being willing to see the whole picture. So bringing your capital and then bringing your voice, both of those were part of what I wanted to.
I wonder how those Marvel creative artists would picture you as one of their superheroes. I'm suddenly picturing what that would look like. It's like, and Geeta has arrived. Dun, 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 dun. And
Small but mighty is what I like to think.
You can see it. You can see it. Right. So let's drill down a bit on the approach that the shop takes, and obviously being influential in shaping that. So, and I've grabbed, as I always do, from the website, and you've shared some materials with me and so on. So let me quote like 4 sentences that jumped out at me on integrated ESG investing. And I quote, visionary management teams with the potential to capitalize on new market opportunities and revenue streams, productivity and efficiency improvements capable of supporting higher profit margins, the avoidance of unanticipated costs stemming from inadequate attention to ESG risks, and as a result, relative to market benchmarks, our process seeks to enhance portfolio quality, return potential, and risk reduction over the long term. Now, first of all, let me reflect as someone with 15 years in the ESG space and nearly 3 decades in the whole space. That's a very well-crafted set of 4 sentences. So, chapeau, well done, hat tip. 2 pieces could you unpack for me, please? The piece around supporting higher profit margins. And then I want to unpack also the avoidance of unanticipated costs, but maybe starting with the supporting higher profit margins thought.
Yeah. So for years, it was argued that we investors could never afford to be distracted by things like environment and social issues and seeking good governance, because it was a distraction, because it would inevitably curtail our investment universe. It would be bad for your financial health, couldn't be done, shouldn't be done, etc. And part of my goal there in writing that is the realization that the pie would be bigger and better if you were more diverse and inclusive. So you gave people a seat at the table, but also gave them the opportunity to be heard. That's what inclusion is. And so if you enable that, and you are broader in your thought process about people as assets rather than as costs to be minimized and managed, that you then would see, because I'm firmly convinced that there are very few sustainable comparative advantages. People write whole books about moats and things like this. People are your comparative advantage most of the time. Execution risk is what's governing this. Take large segments of the developed markets in finance and financials, software, healthcare, travel, tourism, leisure, take entire swaths of the economy, and people are making the difference. And so there I wanted to point out that it isn't by cutting down on the costs of the people, but that their productivity, imagination, and execution would actually widen your ability to grow the pie and make it better.
Okay, good. You remind me of the one of the founders of Pixar, who wrote the book called Creativity Inc., who made that exact point around it's the humans who have the ideas. And then the second piece, avoidance of unanticipated costs. This is so hard, I find, in the industry, because it's always the avoided item that's so hard to price. If it blows up, ask VW, and when something blows up, it's very easy to see that number. But these avoidable costs that one can avoid, dodge, if you will. How do you unpack that, the avoidance of unanticipated costs?
So I look at that as thoughtful governance and leadership or by the management. This could be, you could take this as saying that you have governance of sustainability, governance of diversity, governance of good practice embedded, not merely a conventional board that is, deciding whether to back a CEO on a particular, uh, you know, uh, compensation structure, which is often how we think of boards. And they do belong there, but they have these other responsibilities. So the idea is that you build a culture in which you are able to embed these positive practices such that you are not caught unawares. The memorable ones are the ones where there's a meltdown and it's in the front pages for forever. But even the smaller violations, the smaller infractions, take a lot of management time and are a distraction. They are also, releasing negative energy and changing the culture of the place. So whether it's ethical practices and bribery, or it is the governance of sustainable practices in spills and emission violations, these are or employee practices. I mean, these are all elements of good governance, managing for the long term. And my goal in doing all of this is that the time horizon of the investor is very long. And unfortunately, our modern organizations, the incentives of management are not aligned. The incentives of firms are not aligned. And so the way you align that is by encouraging this type of long-term oriented governance.
Okay, excellent, good.
Yeah.
So moving then to, I had a look at where you're describing the ESG approach. I looked at the US large cap value strategy. You're the PM on that, right? The portfolio manager.
I
Good. So there's an image or a description, and it says portfolio ESG categories, and it's got solution leaders, ESG leaders, ESG momentum, and thematic exposure. So as always, with the podcast, we're very interested in the how, and obviously your secret sauce is your secret sauce, but there's words on the page here, and I think I know what you mean, but it would be really, really interesting to understand how did you come to create these sort of 4 categories, and how do you deal with overlaps? It's just very interesting. So whatever you feel comfortable sharing with us, please.
Yeah, absolutely. I look at the job of a value manager in the ESG space and see 4 sources of alpha, if I can say it in financialese. The first is that there are, in fact, companies that are making solutions to society's biggest and environmental or social problems. These have much greater runways, much more pricing power, much greater consumer loyalty ahead of them than is reflected in the market valuation of those. I think they are also more protected from disruption in terms of technology and so on. So if you're thinking as a value manager, where you are in more conventional companies, most of the time, those companies are avoided because they're usually the target of the much more glamorous, new, disruptive companies with the technologies that are going to change the way things are. But I think there is a lot of untapped potential. So that's one. So what does the company make? How do they make it? We are always looking for ESG leaders. And as I mentioned earlier, I really do think the companies that manage people well, that have a commitment to low carbon footprint, they change the culture of the company and they become much more desirable workplaces and have that culture of excellence that enables them to be better investments, misvalued by the market, not yet reflected by the market valuation. So that's the second source. The third source of alpha is the improving companies, which are better than they used to be, have made a commitment, are beginning that transition. And we have a very strong, well-developed engagement process whereby we can, catalyze and sustain that journey that the company is on and embolden their vision on where they could be and who they could become. And so I see that as a huge undervalued space in which a value manager with an ESG lens, where we have in-house capability and long experience, we can recognize patterns and capitalize on that much faster. And then finally, as a as a financial professional, I've got my own, ideas of what constitutes good value in each sector and what metrics matter the most. And so,
I'm
yeah,
slightly
definitely
nervous you're
looking.
going to say the word Bitcoin here. You're not going to say the word Bitcoin, are you?
I am not,
Okay.
unfortunately,
Okay.
me. No, if anything, value managers are accused of only looking too much for tangible things
Right.
and not, and not, therefore not participating in the more glamorous, possibilities of a growth
Mm-hmm.
story. But I definitely feel that it is it's a misunderstood space. In the old days, you would have said an ESG value manager is an oxymoron, right? Because
Right.
a value companies reached poor valuations by doing something terrible on the ESG
Right.
side.
Right.
They either had a huge spill or they had a huge class action lawsuit,
Mm.
and like they are storied bad actors.
Mm.
And so, how could you possibly be an ESG investor in this space? And I actually think that ESG itself, the risks and the opportunities are misvalued.
Mm.
The timing and the magnitude of the risks and opportunities are
Mm.
misvalued by the markets. And so, right there, it was an opportunity to see things, recognize patterns from experience that your average investor is not, and that is ultimately what a value manager's job is to
Mm.
see it and act on it before it's reflected in the price. And having an independent, empowered ESG team, it strengthens the conviction of the manager, of the portfolio
Right.
manager, to lean in or lean out and sort of back away and sell quickly, both. And so I think this is it's been an amazing journey for me as a contrarian and out to prove a point. It's
Right.
been a fabulous journey. Mhm.
It, it's also fair to say that value managers have had a tough time lately, right? If you had to look at where the performance attribution, and even I was looking back at the Tesla stock, and literally it is a hockey stick with a few notches at the top. I mean, when you've got the market running, it's so hard to say, yeah, price to book, price to book. Let's look at the fundamentals. So maybe give us just a minute on just in solidarity with the other value managers out there. How are you guys kind of hanging in there and making your case?
Absolutely. So I think there's been a combination of things over the last several years that have made stocks very correlated, and also the huge, monetary stimulus has lifted all boats, such
Mm.
that
Sure.
a stock picker's craft has no value.
Right. Yep.
There's no meaning to it. So high correlation among stocks, very low and falling interest rates, making growth and future long duration assets much more valuable in
Right.
the marketplace. I think value managers had some self-inflicted wounds. We didn't navigate quickly to the asset light world. You can't be
Mhm.
hanging on to
Yeah.
only a price to book type of metric.
Right.
And the belief was that all the disruptions would ultimately affect, quote, value
Right.
names. And so they would be left in the dust while all the other people. So what has happened is that I think that correlation, that kind of expectation of eternal correlation is broken. And volatile years like 2020 really proved that point.
Yeah.
The second is that I think that the permanent decline of interest rates and inflation sort of from
Right.
1980 to now, that's like 40 years.
Yeah.
Most people's entire investment career could be
Right.
in just that
Right.
one type of environment. And so that is, I don't think that's eternally continuing. If it is, then we are in much worse trouble than we think
Right.
we are,
Right.
much bigger trouble. I also think that we are uniquely in my approach. I think every sector we use a different valuation metric, so we're not hung up on
Okay.
one or two metrics that may or may not have served their time and may not be appropriate to every sector. And so it is important. We think as sector analysts both on the ESG as well as financial side. So we have our own unique understanding of value. And finally, I want to say that ESG itself has reached this unusual place where people think companies with no earnings and only an idea, an infinite P multiples are somehow ESG. And I would argue um, to take a deep breath and look around you. We
Mm.
need the entire ship to turn, and only then do we have a sustainable future. And so, are there not many names in the enablers space, which is the financial companies whom we've engaged for a long time, and that have to enable the transition to a more sustainable future, have to finance creatively that pivot into a better future, or industries in more conventional places that all have to come along, have to transform. And so for us within ESG, there's a lot of opportunity as a value manager.
And we'll, in part two, we'll drill down a bit, especially on that financial sector piece you mentioned, and then some more of the names. Let's my last big question for part one goes to your Joan Bavaria Award in 2015. Again, congratulations, well deserved, of course. You had one great, many great sentences, but two that jumped out to me. The first one is, quote, "We should all be shocked that ESG analysis is not included in the curriculum or on the exams to become a chartered financial analyst. That needs to change," unquote. Now, we know you're a change maker, and we know also that the CFA charter exams have now got climate piece. After the 2001-2002 drama, they started to have a bit of corporate governance in there. And I'm also told there will be some more ESG. I was talking to Matt Orsag at the CFA Institute recently. Could you reflect, are you today in 2021 satisfied that the CFA charter has sufficient integration of ESG issues in the exam?
No. I think both CFA as well as conventional finance courses, and whenever I get a chance, I talk to academics as well about this, need to refresh and start over, partly because what they do is they do teach sustainability, but sustainable finance is its own little ghetto. It's not in the main center of the plate. And so you're taught finance and then a variant called sustainable finance. And to my way of thinking, they have not reached where they need to until that is in the middle of the plate. And that there is only one thing called finance, and that is able to see all around it. It does not wear selective,
It's not on another planet,
if I can call it that, but exactly, and is fit for purpose for the future, is future appropriate, and and future prepared, because this is what MBAs and CFAs have to be thinking as their job, which is not to teach things as they were, but really how they should be and what world these students need to graduate into. And so personally, I think they have a long way to go. I'm glad they're no longer in denial, which is a great step forward. But I think they've got a long way to go.
Fair comment. And then the second sentence from that same speech, it's on YouTube. I will include in the show notes if people would like to look at it. This is a segment. It says, "Institutions with substantial equity holdings share a permanent structural interest in the long-term health of our ecosystems and the economy." I thought that was just very succinct and very crisply put. As you reflect back, it's 2015, 6 years really since you spoke that sentence. Would you say it that way today, or how would you update that, or does that hold up, do you think?
Well, I think, again, in some quarters, I think that is no longer such an unusual thing to say. I called it structurally aligned, and people are calling it systemic risk. I think it's a good refinement of the term. The recognition that you can't divest or diversify your way out of these risks. The idea that you are, for better or worse, even as an active manager who owns only 50 or 60 names, I'm not invested in all those systemically exposed names, but the risks they cause take down my 50 or 60 names as well. So as an investor, there's no real place to hide. And the second thing is that we investors are acting on behalf of someone, right? A beneficiary whose timeline is different from ours, whose life and whose investment opportunity, let alone the benefits they could enjoy from this. I mean, we are still adjusting for inflation adjusted returns. Investment policy guidelines are still calling out those. But really what we should be focusing on is the quality of life that we are enabling our beneficiaries to enjoy. And so I feel we are inextricably linked: investors, asset owners, corporations, and kind of all the ecosystems within which we operate.
Yeah.
Yeah,
Good.
we may try to build walls and cordon ourselves off, but reality keeps reasserting itself.
Yeah,
So
it does. So let's get into wrap part one of the deep dive. The question I'm asking across all my guests is this: I'd like I'd like to unpack or look at a key performance indicator. What is the price for CO2 equivalent per ton that your firm uses internally for your operations? And second part of that question, what price for CO2 equivalent per ton is in your portfolios, or shadow price is in your portfolio?
yeah, you're actually drawing my attention to where we need to be. What we've done internally is that we've tracked our carbon footprint, our space, our travel, visitors to us, all of everything that we have an impact on. We've tracked it and we've tallied it and tried to offset it. And so it has the effect of giving a feedback loop within the firm. It's an expense and we have to underwrite it and so on. So it has some effect there. But I think you're raising the point, which I think, going back after all this period of not traveling and not being in the space and not really incurring those carbon footprint costs, that we might restart by having a budgetary tripwire, which is an internal price of carbon. That's a very elegant concept of formalizing what we were trying to do. So that's really brilliant. I've taken good notes. On the portfolio side,
I'm the ESG architect. I'm here to help.
Absolutely. And on the portfolio side as well, I mean, we track and we report on our carbon footprint of the portfolios. As you would expect, we come in at a much lower carbon footprint, and we also have a innate competitiveness that a year after year, or compared to other products or compared to the benchmark, we want to be investing more in solutions as well as companies that are low on their emissions and effluence footprint. So we are trying to improve on those dimensions. We engage to improve, but again, we are not pricing the carbon. We're not doing enough to completely avoid. And so what number would that be? And I've given a lot of thought to that. And I think that honestly, there's every incentive to think of it as having a very, very high price, because the idea is that we are very late and solving for economically rational prices isn't enough. And that we really need to think that if there's a small probability of a very catastrophic set of events, then the present value of that has got to be thought of as insurance. A small chance that your house will burn down provokes all kinds of precautions. And so from our perspective, I think the unseen complicity that we are all guilty of, it can only be addressed if that price is really quite high and quite remarkable.
Yeah, and I think 2021 and the next couple of years, who knows what happens at COP26. I think that number and the pricing, we've got to ramp up that conversation. So thank you very much.
You are listening to the ESG and Coffee podcast on investing, strategy and sustainability. 您现在收听的是 ESG 和咖啡时间，投资策略和可持续发展。
Let's change speeds then and get to our second round of espresso shot questions. You ready?
Yes.
Here we go. What app are you, Geeta, most likely to be viewing on your smartphone while waiting in line?
I'm a global news junkie, so it's probably BBC or New York Times or one of those news channels, apps. Yeah.
What book did you enjoy reading recently?
I read Homegoing by Yasi, and it's a book, it's a historical fiction about a set of families, a founder and descendants of a family in Ghana. And it really tied it for me to from the Ashanti background through slavery, through a very tough set of journeys. But historical novels, I'm a history buff. And so even in my choice of novels, I read biographies or historical fiction.
Okay.
Yeah. So it's homegoing, and the author is Ya Gyasi.
Lovely. We'll include that in the show notes as well. Thank you very much. What is the best kind of pie?
Apple pie, without a doubt.
All right. What is your favorite movie or on-screen moment that relates to the world of investing?
Oh, God. It's that terrible moment, said without irony, the Gordon Gekko moment in Wall Street, where he says, greed works, greed is good, greed, et cetera, and goes on to clarify how it clarifies thought and ultimately, in a very ominous way, ends by saying that it will also fix that malfunctioning corporation called the USA.
Right.
And from there began our ideas, the ideas of the 80s. Which transformed the notion of a nation state and its obligation to citizens as if it were a corporate entity to be run along those principles. It's just like a ominous comment.
Yeah, I'll include in the show notes the link to the YouTube video as part of the 25-year anniversary. They interviewed Oliver Stone, and that whole speech was meant to be the speech of a scumbag and an anti-hero, but unfortunately it became a clarion call for a whole generation.
Yes. Michael Douglas as Gordon Gekko. It's like exactly. Without any irony. Yeah.
Right. Okay, and then finally, as an investment professional, what has been your most meaningful success so far? We wish you many more years of success, but so far you look back and say, this is one of the happiest successes so far.
I hope it will be that we have established that you can have financial returns and make a difference to corporations, that we track our impact on companies, and our returns are obviously tracked by many.
Right.
So without compromising or shortchanging the sustainability side. People used to say the other way around, right?
Right.
Can you be sustainable without giving up financial returns? And I want to say the other way around, right? Can you have financial returns while still being a sustainable investor and making a difference? And to me, that's the proof statement. That's my pursuit.
Wonderful. Yeah, and this is like unplanned, but my bonus sixth question would be, so where's your book?
I've been writing small chapters, literally one pages.
All right.
Like one a week for the at the intersect of sustainability and finance. So one day I hope there will be, very short, appropriate to current day attention span.
Yes.
Vignettes that
All right. Well, I'm hereby volunteering live as a proofreader for free. I'm part of the team. Okay.
So now I have to get it done. Yeah.
Yes, that's the other part. Because I need to read something in order to proofread. Yeah. Good.
Right.
All right. So let's move to part two. We're going to drill down a bit more on the portfolios you manage and the approach. And then part three, the drill down is going to be more on that engagement, which your shop has done very well for many, many years. So drilling down then on the US large cap value strategy, and I've pulled some information from your fourth quarter 2020 update. I've got a few things I just want to reflect back to you that jumped out at me. First of all, the holdings you referenced earlier about the kind of the focus that you have. The holdings are around 53 at the end of quarter versus Russell 1000 value at 825. So let me kind of push you in the other direction. Why not all the way down to 30? If you're going to get concentrated, could we squeeze you even more to 30 to get to really back your hypothesis, or do you need to be in the 50 range? So I'm just interested in the holdings.
You'd be right to ask that question. We are active managers, and so of course we are, very far from the benchmarks or the index funds out there in terms of the numbers. But we are aiming to have a broadly diversified portfolio for a couple of reasons. One is that I would like for the sustainable investor to feel year to year that the volatility is not so great as to scare them away from investing. And I do believe that there are solutions and better ESG actors in every sector, and we need all sectors, including the difficult ones like utilities and so on, to be in the lead in order for us to make this transition.
Okay.
So I think there is opportunity across the board, not equally so, and we don't, we don't invest based on the benchmark or any other.
Okay. Okay.
The second is that um, we are often in the process of not owning some of the largest actors who may be somewhat problematic. And so as we go down the size spectrum in terms of the names we hold, um, or when a name or a theme or a focus area is being built in or phased out, we may have many names in a segment.
Okay.
And so it ebbs and flows a little, but it's not ever by design. It's not at the 35 level, as you pointed out. It's in the 50 to 60 or 50 to 70 name range.
Okay. Then unpacking a little bit on some of the names that were mentioned. There was one phrase I grabbed, I think it was off the fact sheet, I think. It said, valuation does not reflect improving ESG, Weyerhaeuser, Citigroup, and Kroger. And I was hoping you could just unpack that a bit more, because I'm teaching again MBAs, and so this issue of what's in the valuation, how is ESG integrated in whatever your method is, and then what do you do when the valuation diverges from positive ESG performance or vice versa. So I'm just curious about that comment.
Yeah. So these are companies. Citi is a large bank which has been transforming, in our opinion. And we were early to see the pattern of their transformation. They stepped out and signed climate-related statements. Most recently, they stepped forward towards net zero.
Right.
They've appointed the first ever woman CEO. I believe that there is what we call intangibly ESG momentum. There is clearly a bit of, relative to their peers, they have exposure to loans to fossil fuels. They have all the challenges of a large bank that anyone might have. But I believe that their pivot was underappreciated in the markets. It's only now, when it's front page news that they have a woman CEO and that but they have signed on to PCAF, which I'll talk more about later. The principles of carbon accounting financials. They've made some strides where only Citi and the next signatory in the US and during Climate Week would be a tiny bank. And so the types of climate commitments they were willing to start making drew our attention to that bank.
Okay.
Most of the large banks, the money center banks, are not in our portfolio. This is the only exception that we make. In the case of Weyerhaeuser is a lumber REIT, real estate investment trust. Forestry and sustainable forestry is an important aspect of carbon sinks. Right. And we have been in engagement with them alongside management in the creation of the understanding of how to safeguard these assets within the private sector, which is such a big part of U.S. strategy,
right.
And to think of the sustainable forestry as their calling card. We are currently engaging them. Okay. Kroger, we had some concerns as a grocery store chain around diversity issues. We had engaged them. They have improved. They have taken other strides beyond that towards improved workplace practices during COVID crisis. We are engaging them on diversity, inclusion, and equity, workplace-related equity. We also are engaging them and talking to them about, improving the products they sell, plant-based proteins, making a broader push into the value proposition that a grocery store represents. We think banks, grocery stores, etc., yes, they can do a lot of good through the staffing and workplace, but their value chain role, which puts them in contact with the supply chain and a forward-looking product definition and stereotype can make them far more impactful than they already are.
Okay, good. One other name that I spotted, this ties into one of kind of my big ideas that I'm tracking longer term, is an HVAC name, Carrier Global, right? One of the big brands. And on one of my previous interviews, we were talking about a different vendor, Dakin, one of the competitors. So curious why you prefer Carrier, and part of the challenges is that no one's figured out how to make the lowest carbon, lowest energy air conditioner, and technologically it's challenging and so on. So what is your positioning around, I can see why you might have them, energy efficiency, including end-to-end, but really the leap is, it's like going from a more fuel efficient gasoline car to, no, we really need EVs now. So are you able to kind of push them on the technology side?
We are, and actually refrigerants is a big part of our engagement this year. So let me start by saying that the reason we bought Carrier is that they were a division of United Technologies. We would not buy United Technologies, but when they were spun off, because we knew the company and had done the work, we were able to get into the company long before there are established sell-side opinions or ESG reports. So part of the benefits of experience is that you've seen this before and you can recognize it when it comes out. They are makers of energy efficient both refrigeration as well as HVAC on both sides. So their footprint is lower already in terms of their products, as well as our own engagement priority, which is towards improvement of refrigerants. Because if you recall in the drawdown list, I mean, the number one challenge is that we will all, as humanity, go much further into using, I'm going to say hydrofluorocarbons, but anyway, I think it's HFCs, and that we have the opportunity to improve on that dimension quite substantially. And our engagement, one of our engagement focus areas this year is on that, though it's a small part of companies because of its critical importance in the impact it can make because of the greenhouse gas emissions impact.
Okay. Another piece that came out of that same quarterly, and this for me goes to kind of putting myself in the shoes of a value manager, right? And so, as I mentioned earlier, price to book is obvious to me, price to sales you reference, and free cash flow yield. So, which is really a comfort level about how you're able to service commitments. So what is, as a value manager, with or without ESG, what are your favorite ratios that you're watching now?
Most definitely in the case of things like industrials, it's enterprise value to EBITDA, which is earnings before interest, tax, depreciation, amortization. We also look at, within financials, we like to see the return on assets, the non-performing loans ratios, things like that. So depending on the particular sector, we are looking at a favorite indicator or two. And overall, we need the companies to be profitable, to be real in terms of generating free cash flow, and to not be, all in the future to discount. So clearly that's the footprint, along with, if possible, yield or buyback of stocks as a return of capital to investors.
Okay, and then my next question, just a small one, just based on reading your ADV. Every fund manager in the US reports to the SEC on ADV. It's different in other regions. So as I interview people in different regions, it's not relevant, but US ADV. So I was reading through the risk section, and I couldn't find a line item for climate risk in ADV Part 3, risk of loss. So I'm curious, is that required by the SEC, or is that guided by the lawyers? Or I just, ever since 2018 happened and Larry Fink said what he said and had such an influence in the market, and many have been saying it for decades before that, of course, but here we are. So I just, as I read down, I'm like looking at small, exchange rate risk and then I just thought I'd see climate risk. So I'm just curious about that.
Yeah. It's ironic, isn't it? Because in managing our own portfolios, we think of, essentially climate change environmental factors, as in rising toxicity, inequality without mobility, corporate capture of policymaking. These are the major risks in the economy that we are aware of and managing around. And yet, in terms of risks to portfolios, well, for one, I hope that if it's all relative, then I'm hoping we will be less risky than the alternatives, which is the benchmark or other managers who are not so mindful. But you're absolutely right. I don't think goes back to the what I said about finance as taught in business schools and CFA learning, which is that people have not internalized that actual risk and loss of capital can happen and does happen around the world from climate-related events, and that we need to call those out in the center. We are busily dismissing these as one-off, black swan events. We're busy dismissing them as, somewhere else in the world and only either infrequent or really not connecting the dots to see it as having potential to destroy actual portfolio value. And I think it's until we call it out, and maybe we should, just as a statement to the S&P. You're exactly right. You're giving me a lot of great ideas today, Graham.
Thank you. And well, we connect also too because of your work in emerging markets and that global perspective you have, because you have lived and experienced the world differently, as have I. And so as I was reading down, it's like emerging markets risk. So then my thought is, well, there's some classifications that still call China an emerging market, but China's either the largest or about to be the largest economy. It's just someone created these buckets and they get filled out. And like, when do people sit back and go, well, these are old buckets. We need the new.
I think, So just a sentence on the emerging market thing is that I think there's a risk that people perceive from nationalization or threat of assurances of continued free market, open liquid markets. And that's where that emerging market categorization is coming from, the belief that there are political risks that might intervene in terms of return of capital.
Right, very good point. I clearly see that you're going to have to come back for a second interview on the podcast. We're flying here. So moving on then to just a phrase that I enjoyed, again, looking at your ESG guidelines now. And I threw up some examples. I'll kind of run them through you and just see what your take is on it. So the Boston Common Asset Management ESG Guidelines 2021 have this phrase, purity and safety. I love the phrase, by the way. Purity and safety. Yeah, we all want to be safe and pure. Demonstrate a history and pattern of marketing unsafe products, asserting false marketing claims, or engaging in irresponsible marketing. Now, we're going to talk about greenwashing in a bit, obviously. But we have to talk, well, I'm dying to talk, if you will allow us, about flushables, because I had the plumber come visit this week and he was telling me horror stories about piping and sewage works getting clogged with flushables, which aren't flushable. Then my personal favorite, and this goes back to my work on the Access to Nutrition Index, which your good colleague Lauren Compere was brilliant in supporting that, more than a decade ago now, where there's a brand of drink called Vitamin Water, which is owned ultimately by Coca-Cola, energy brands owned by Coca-Cola. And they were the Center for Science and the Public Interest sued them about a decade ago about the levels of sugars and their marketing claims. And there was this legendary quote from the lawyers defending the suit against Vitamin Water that said, the allegations are ridiculous on the grounds that, quote, no consumer could reasonably be misled into thinking Vitamin Water was a healthy beverage, unquote. And we can talk about, clean coal or partial zero emissions vehicles. I just love your phrase, the purity and safety aspect. Tell me about some of the fun you've had with that.
It's difficult. It's one of those that people think automatically comes from some values place and you must be very judgy, judgmental. And honestly, we are really looking for safe, quality, desirable products that, when used as intended, don't cause harm.
Exactly. It's on the label.
So it's not like if you misuse something, but it's really when used as intended. So Are they making claims that are, overstating the case, or are they even making a product that, is contributing to your poor health, or is making some false claim about contributing to your good health?
Right.
Either way, we think that it's not worth holding in the portfolio. So my view is that if you don't look at products and only at process, then you go down this path where your top 5 ESG names can include, mining companies, tobacco companies,
Right.
makers of chemical weapons and the like. And so I do believe investors cannot just hide behind environmental, social, and governance practices, and must look at product. And so it's always been an anchor of what we do, not only what we avoid, but more importantly, what we seek, because that's what we own. And so, and we don't think that there is much use in engaging to improve a company if you don't agree, with what they're making. So I don't want to sit there and tell Philip Morris or Altria or whatever how to make a better cigarette. It's not useful to me with a lower carbon footprint or with any other metrics. And so that anchor is reflected there.
Yeah, this is going to be one of the most fun chapters in your book, by the way. So I'm looking forward to this part of the book. All right, let's move on then. You referenced earlier, and I'm glad you did, because I would like to learn a bit more, the platform for carbon accounting financials.
Yeah.
So can you give us just a quick background, and then why is it worth your shop getting involved? I mean, there's so many initiatives out there, all doing great things in different ways, fantastic. But how does a shop like yours, you're not a mega shop, right? And you've got to make your time and attention and intellectual contribution allocation decisions. Why is this one worth your time and attention, Geeta?
Yeah. So notice that the focus is on carbon, and the membership is of financial companies, and that drives our engagement and participation. We divested from fossil fuels. We are also recognizing that, honestly, supply exists and can be divested from, but demand is what keeps the supply going. So without efficiency and without disruptive technologies, there is no way to move forward. And then the second is that financial companies are enablers of this continued uh, use of fossil fuels, including finding new reserves that can never be used and the stranded assets problem, but also the lack of pivot towards financing of renewables by deeming them to be risky or uncharted or otherwise. We're going to need all their creativity and ingenuity. So we need to create incentives within the financial structure, the financial system, the financial players to start thinking differently. And so everyone has their own theory of change. And one of ours is that we think that you need the sustained engagement of investors. So that would be people like us. We need improved data, and clearly Carbon Tracker, Carbon Disclosure Project, a lot of players in this space are creating that.
Yeah.
And then you need an ecosystem in which companies challenge each other to improve. So it's a coalition of willing players who are in there to share best practice and create a race to the top. So you need an ecosystem where you can compare yourself to, you can calibrate accomplishment, you can identify creativity and urge each other to improve. And that is a very leveraged place if you reach there. And so PCAF is started by a few Dutch and other financial institutions, ABN AMRO among them. We became the first North American investor to join this, in part because we think that the United States is an enormous player in this, and we need to be able to move forward into creating this urgency. And so it's a very leveraged impact on carbon, though it looks like finance. Because without it, I'm convinced that we cannot make this pivot. There's no sustainability pivot without finance, both on the avoidance and on the seek side.
Fair comment. And then pulling it into, so what are you able to do today, tomorrow? Is there any piece of this platform and the carbon accounting that you can already put into your models, or you're trying to pull something and it's only going to play out in a year or two's time?
Yeah. So, clearly the disclosure aspect, measuring things that have not been conventionally measured, making, also sensible metrics that are useful in making trade-offs and comparisons, urging more financial players to join. So at our urging, number of financial players that we've invested in have signed on to this and will join this coalition where they are in the company of others like themselves in a race to the top.
Right.
We believe that small investors like ourselves have to be catalysts. We have to be catalyzing these changes and urging larger players to vote with us, participate with us, and raise their ambition level. So I think it's all about leverage. That's why I said small but mighty is what we aim to be.
Yeah. All right, let's wrap part 2, our deep dive. And we talked about greenwashing earlier, so let's talk about it for a moment. Do you agree greenwashing is real? And if yes, why does it matter to the work that you do?
Yeah. It is because there's a tendency now to start labeling, and it's difficult to establish quality or showcase quality when it's the claims are all around you, undifferentiated. So on the one hand, I worry, and on the other hand, I'm encouraged because they all want to be us. So for a long time, I mean, our battle was that it was scoffed at or viewed as
Right.
impossible to do or bad for irrelevant and distracting, and so on. And even as I worry that there isn't a way to differentiate enough, and that there is people need to learn to use judgment and look under the hood and be more accountable to the data and use some amount of discretion beyond the claims that are made by people. So yes, greenwashing does bother me. But we need the willing coalition of all. We have a huge transformation to accomplish, and we need all hands on deck. So if they're not pulling against you and they're pulling with you, personally, I would like them all in our tent. For us to make the shareholder proposals, for them to vote, whatever everyone each at their speed can do is needed.
Right.
I
pushed back a bit on Martin Skanker recently. He's still at the PRI, I think, and I know you were a board member for a while. I have some difficulty with, at some point a tent that has everyone, that's just the sky. That's no longer a tent, right? So I hear you. My reflection back is, and this is where the Europeans, for example, have gone, right? Where, I don't do ESG, I do ESG light, or I'm doing dark green ESG. So we've got to help the buyers of investment services and all looking at the portfolio companies and how they're interacting with their their buyers. We've got to help them make clear there's failing slowly, predatory delay is still a failure. So it's about velocity, speed, and direction. So that would be my reflection back.
No, I couldn't agree more. And I think, we need to speak more loudly to why we are doing this, not just to decarbonize portfolios, but to decarbonize the planet. So if all we're going to start accomplishing is only, putting low carbon labels on things, that just means that your portfolio is not going to be as affected, but it doesn't mean the problem is solved.
Yeah.
Right? So,
good point.
Yeah.
You are listening to the ESG and Coffee podcast hosted by Graham Sinclair.
Okay, grab a sip of coffee and espresso shot question set number 3. Here we go. 5 questions. Question number 1. Do you have a favorite type of tree and what is it?
It's probably not going to qualify as a tree, but where I grew up, where my family is from, not really where I grew up, is Kerala. And we have a lot of banana growing there. Okay. And it's not full on a tree, but it's more like and yet every part of it is useful.
Yeah,
it's really there's not even one piece that's wasted. The leaves we eat on, the thread, from the trunk is used. The inside, the xylem and phloem, we eat them. The flowers, every piece. And then after that, right next to the first tree, there's a new one, a daughter banana plant.
Yeah.
right next to it.
Right.
So to me, it's always been a metaphor for something very remarkable. Yeah.
Yeah, the way I grew up in South Africa on the southeast coast, which is on the Indian Ocean, it was known as the banana province because we had a lot of those banana groves. So I picked that very well. Question 2, espresso shot question set number 3. What one book on investing would you recommend?
Oh, that one's actually a very difficult one, and I think that I think reading books on history, on economists, these are of much greater use. So in my mind, if you read a book of biographies of great economic thinkers and saw it for what it is, a set of assumptions that are useful, but also always in need of updating and refreshing, that's the attitude I would love to. So I guess I've got to write the best book on investing.
or like a compilation of the best chapters of like 10 books, right? And because as you say, until you read it in the context of where it was written and you understand as deeply as you can using experts to guide you on what they were trying to say and what they meant, and so you can figure out, no, that wasn't great, or no, this is an excellent insight and it still works in 2021.
Correct. Yeah. Mm-hmm.
All right. Question 4. What would your advice be to your 17-year-old self today?
Try everything. You only live once.
Okay. I'm still seeing the Marvel superhero. And that's...
No. I think most women and most have what I consider to be almost entrepreneurs have, bounded risk taking, like a fear of failure always underneath it. And that's why I want to go back and say, don't worry, it's okay. Yeah.
Fair enough. Except for skydiving. I'm not so keen on that. What is your advice to people seeking to enter the field of ESG investment and finance today?
Come on board, and we need every hand on deck. We need your creativity and your irreverence in the mix. Excellent. Don't look for the orthodoxy and don't think of it as entering a well-established field of finance.
Yeah. In a way, it's reflected to me if you look at how SpaceX is building their rocket ships that are meant to go to Mars, and they're literally building it in the scrubland in coastal Texas using, the cranes and what have you, which is very different models are possible today.
Yeah. Mm-hmm.
Okay, so let's deep dive 3 of 3. Here we go. I want to unpack a little bit on the Sustainable Emerging Markets Equity Strategy and the ESG Impact International Fund, if we can. First of all, because the Emerging Markets Equity, which has coverage in Taiwan, has a bicycle company, and I'm a big fan of cycling. Do you cycle? Do you enjoy cycling?
I do. I don't do enough of it, but yes, yeah.
Good. I was hoping whatever promotion of mobility or e-mobility would include something for electric bikes, because those actually can be very useful in urban environments and for older people or people who struggle to actually cycle, or it's very hilly. Just to have that, there's a lot of people who try them, I think.
Totally. Yes, I agree.
So you have, as part of the thesis, you have it in your portfolio now. Giant Manufacturing, anyone who cycles will know the Giant brand. It's been in the professional peloton for years. Sells about 6 million bicycles annually, it says here. So what was the thesis for that? Was it, the move to bicycles, or was it reflecting on what happened with COVID and people were trying to get out while they're stuck in their houses? Or was there something in some kind of 10-year view that Giant has convinced you they've got this mighty long-term plan?
No, we view the product as part of sustainable transportation. So we are, like I said, we are good with the product. We also saw the opportunity, it's well established, all of the things you pointed out, the crowding, the convenience, the growing use within cities and so on. We view the company as a leading player and one that would have ended up having a far stronger end market in the wake of COVID, and hopefully some of those changes remain in place going forward.
Mm.
And so, for a variety of reasons, this is the type of company where we want to participate
Right.
in this visionary management's ability to execute and go forward,
Mm.
and a company that we're happy to hold and invest in. Mhm.
Good. I look forward to seeing the annual review cover photo of the whole staff on their giant bicycles at some point, right?
Right.
Good. And then another piece that just jumped out at me because it reminded me of mixtapes in the 80s, sitting by the radio trying to grab some. In the Boston Common ESG Impact International Fund, you've got TD Corp. So I'm assuming that's like TDK, like they used to make the cassettes. What
Yeah.
do you have a view and a 2.8% holding? So, top 10 equity holdings. Any comment on TDK? What are they doing? I'm not familiar with what they're doing nowadays.
Yeah, that's one that I'd have to look up. I
Okay.
haven't looked at it in a while, and
Okay.
yeah, I would
Okay, good.
rather, yeah.
So let's move forward then on ownership, if you don't mind just touching on it briefly. I think a highlight for you, it was covered in the press. AMG Affiliated Managers Group, listed on the NYSE AMG, purchased a 15% permanent
Yeah.
capital stake in Boston Common. Congratulations. I think that's an affirmation, as it gives you kind of a robust underpin. I'm assuming there's a lot of other business benefits, but you remain very much kind of an owner managed shop, I think, which
Yes.
for me is really a quality signal. When it comes to looking at an asset management shop, I'm looking to, are they invested in their own strategies with their
Yes.
personal assets, and who owns the business? So
Yeah.
I do like the framework of a Vanguard where it's a mutual, so the clients also own it, but very much so if in an asset management shop, if the portfolio managers and analysts and everyone owns their own shop, I think that
Yeah.
aligns the incentives excellently. So a moment or two, if you will, on how you have set up the ownership structure and how the buy-in from AMG is going to help you.
Yeah. We remain a majority women-owned, women-led firm, majority employee-owned firm. 15% is owned by AMG. So I want to first say that they allow us to maintain our commitment to diversity, and we, between women and people of color, we are the majority owners. Women own 54% of the firm overall, and also constitute a substantial portion of our investment teams, and also along with people of color, the majority. So that was important to maintain. At the same time, we know that in this modern era, distribution is going to be important, and that though we believe we have a quality product, all those greenwashers, as you said, there's a lot of product entering our space, and having good distribution would enable us to have greater impact and achieve more distribution for our strategies, which we think we have a story to tell. We have something unique to offer, and we gain the option to use the distribution that they provide.
Yeah.
So that is another reason why.
Yeah.
As a small firm, we didn't want to sell out in order to gain that distribution. We wanted to find a way to remain independent and have the option to do that.
Okay.
Yeah.
I think it makes a lot of sense. I haven't told you this before, but I was approached about 2 years ago, and someone was pushing me on what small independent shops they could hoover up. So I don't know if it's connected to that in the longer term, but I know other people have been sniffing around, and a lot of people have been asking, where could we pick up a boutique, either to reverse engineer what they're doing across their own shop, or just because they wanted some exposure. So horribly running out of time now. We're absolutely going to have to ask you back. Thank you for being such a good sport. I want to take our last segment of the deep dive to look at engagement. So for me, Boston Common has always stood out because your engagement, your activism absolutely matches up to what you put on the tin.
Yeah.
And in many different ways. I referenced earlier the Access to Nutrition Index that I co-designed, and Lauren Compare and your team have been involved in that. And then we launched it in 2013. So Boston Common was one of the 45 investors. We had 2.6 trillion in assets under management when we launched that. And then if I reflect, and I saw you reported that Boston Common is one of the top 10 on the PRI platform, the collaboration platform. And you had 975 initiatives and 9 projects led. I'm quoting here. So talk to me a bit about how much effort and how much attention and cash allocation from your shop. How do you think about the business model of engaging with portfolio companies? Because one of the criticism I often hear when I'm trying to make the case is, yeah, but effectively we helping change the company, and there's this long tail of other investors who are going to benefit, but we're bearing the costs of helping with this engagement. So I wonder if you could just spend a minute or two explaining on how you think about it as a shop, because it's core to what you do. What is the business model of engagement that you do?
Yeah. I mentioned earlier that we definitely believe in having an impact. Social change, the pursuit of social change is right up there alongside the pursuit of financial return. And so it's really integral to what we are trying to do. And so perhaps we are not entirely, money rational about it. At the same time, I want to point out that, we come to it with a lot of research-based knowledge. My colleagues are leaders in this space. Our convening ability to pull together a coalition of that size fairly quickly comes from the credibility and knowledge and experience that they've built up. And so we may be only 4 billion under management, but our coalitions are often, as you know, 1 trillion or many. So it's a global reach and recognition that we've built up over time. And they are part of the founding group of the firm. And so this was part of what I set out to create with Boston Common, is that this is not some cost sector to be managed down or some afterthought to be applied after the fact. It's very much integral. In our investment approach as well, the engagement as a catalyst and a sustainer of improvements on the ESG side and on the product and services side is very critical. So we believe that we are there to improve the products, the policies, and the processes of the company. This improves the fundamentals and ultimately gets reflected in the valuation of the company. And you're right that it ends up benefiting others. But as I said before, if we don't change these things, it doesn't matter how pure we are, we're going to be swamped by those same systemic risks. So we might as well step up and start doing that. And the more coalitions are built, the more we will gain leverage, and we'll do the more value add, more ambitious, more dynamic, evolving issue, cutting edge things. And that's really been the beauty of where this movement might take us. Same with the ESG research. As the data providers come on board, we get to do the more value add thinking instead of gathering primary data. So it's actually been an evolution for us.
Okay.
And I definitely think it's part of our brand. Yes. And we wouldn't have it any other way.
Yeah. And then very quickly, just building out on that, I looked at the interesting detail on your strategy. It looks like you've got a 3-year cycle on engagement. So you got a 2021 to 2024. And then you actually had a breakout on diversity, firstly, just gender diversity, male, female, and it was different per region. And obviously any intelligence on what works locally or what are the local culture will suggest to me a more sophisticated approach where you understand what is doable, what's within reach, how far to move things. So that kind of stood out for me.
Yeah, we've been global investors from the get-go, and we realize that shareholder rights, expectations of corporations, etc., have to be adjusted to the local conditions. And so, yes, we do vote our proxies, including on the proportion of women or since the very beginning, if we don't have a person of color, we voted against US boards. And so we've set up different expectations of different marketplaces, most definitely. I would also say that in addition to a 3-year rolling program that we keep updating, we also have when we do the research on any company, we identify areas for improvement. So it drives a bottom-up aspect of our engagement. And there's also room for opportunistic engagement. Sitting here in the US, we have to engage on, gun control and immigration and private prisons and, whatever comes up, including abridging the rights of ESG investors, which was all underway until last year. So we take on whatever. We have a little capacity also for that.
Okay, good. Well, that brings us to the end of the deep dive number 3. And let me wrap that with, I'm writing a book on the history of ESG in 100 moments. It's not meant to be a heavy book. It's meant to be interesting and anecdotal. There'll be some images. So let me ask Geeta, asking you, if you open this book one day and you're paging through it and you go, whoa, hang on, this moment is not here. And this absolutely, for me, is one of the top 100 moments. What would that top 100 moment be for you and why?
I think 50 years ago, ICCR was founded, and that's the Interfaith Center for Corporate Responsibility. I'm privileged enough to serve on its board right now, but I believe that it's one of those organizations where, for the first time, the idea that you could use the reach of a shareholder to engage a company and use voice in addition to capital to make a change was done. It's been 50 years, and it's hard to believe we're still proselytizing on the importance of not just being passive and actually engaging on the things that you own.
You're listening to the ESG and Coffee podcast, hosted by Graham Sinclair. Вы слушаете ESG and Coffee podcast. С вами Грэм Синклер.
Okay, great.
Yeah.
Thank you so much. So let's, we're coming into land here. Last set of espresso shot questions. Are you ready?
Ready?
Last set, here we go. And then we've got our Goldilocks question to come. So, and this is a mush of the Proust question that used to be at the back of the Vanity Fair and the Bernard Pivot version from inside the Actors Studio. What is your favorite word?
It's possibility. I'm an eternal optimist. I think I see the challenges, but I believe we are capable of so much. We are capable of so much.
Possibility. I love it. What is your least favorite word?
Orthodoxy, I guess no surprise there, is the opposite almost. The idea that this is how it's always been done and how it should be done. That just like gets the rebellious in me up immediately.
I can picture that. That would be the anti-hero in your Marvel comic. I think we've nearly finished that concept now. What profession other than your own would you like to attempt?
I would have liked to be in healthcare with intrinsic value to your work. I don't know whether it's nursing or medicine or some other function within it, but I feel like that it has intrinsic meaning and value. And
okay, and then in the other direction, what profession other than your own would you not like to attempt?
I would not like to be the CEO of a company selling a product that has no positive purpose for existing, because then every day I'd have to work hard to grow it. And that would be really devastating. Have to grow it while knowing that it's not, so it could be a consumer product, you and I could connect on that one with the access to nutrition work and branding and labeling, but I'd have to be creative every day to justify why it should be bigger. And that would just, I can't imagine a worse life, getting up every morning.
Thank you. That's a useful answer. Right. Which living person do you most admire?
That's actually a very difficult one, a very, very difficult one. And so I've gone through several options there, but I think I'm going to go with someone dramatic like Bill McKibben for moving the 350.org process forward, kind of creating the echo of the South Africa divestment effort.
Right.
Adding a set of real world considerations and quantifying the stranded assets piece and like calling it out and creating a movement around that. Divest is a blunt instrument. I'd be the first to say that as a financial professional. I feel, that's like very basic. But to get everybody energized and to bring it back to the boardrooms, the conversations in the endowment and foundation meetings, it was really an echo of that first moment of South Africa divestment for me. Okay. And I thought that they did something. They moved the dialogue.
Weaving two parts of my journey, South Africa and Vermont, together with that. Which talent would you most like to have?
Ooh, I would love to be technologically much more savvy. Yeah. I see my kids and they're like able to do things so fast.
Okay. So a stretch goal would be get Geeta on TikTok. Is that where we're going?
Yeah, there you go. Yeah.
What do you consider your greatest achievement?
My greatest achievement is still to continue to be able to build a successful business. Only 1.3% of assets in the United States are managed by women or minority-led firms.
Right.
And so to be able to build the improbable journey of building a business, in a difficult terrain, adding to that the improbable odds of an ESG-related active management in the time of passive management, all of those, right? That combination, I feel very blessed and lucky. But I think
we just
creating
need a
that
book, Geeta, The Improbable Journey. What is your idea of perfect happiness?
sitting by the ocean, actually, seeing its calmness combined with its vastness at the same time.
I can feel that. Before I ask the final question, the Goldilocks question, let me pause quickly and check with you. Was there one question you really wanted to answer that we never got to?
No, I think we covered a lot. Thank you.
Okay, good. So here we come into land there with the Goldilocks question. One share of Tesla, TSLA, was trading at yesterday's close on NASDAQ at $635 minus $6 on the day, less than 1%. Is that too high, too low, or just right?
Well, personally, I think that it's not the kind of company I would invest in. And so from my point of view, it's probably too high. But more importantly, it's not something that I think much about. So what I would say is there are 4, which is irrelevant, but would be my answer. And the reason is this, that it is very much a part of the solution, yet it leaves so much to be desired on governance and process and practices, such that it's a transformation of the company. To price those externalities probably will not leave it at the price at which it is.
Okay, thank you. Well, you've been a fine guest, Geeta Aiyer, founder and president at Boston Common Asset Management. You are one of the originals. Hear this from me. Thank you for your hard work over many years, making new paths in the practice of investment and finance. I like to say the investments you make become the world that we all live in. Thank you for trying to make it better. And thank you so much for choosing to come on the ESG and Coffee podcast.
Thank you, Graham, for the opportunity. And I think to be continued.
It's a conversation we will continue. I see a part 2 in our future. Thank you very much.
Thank you.
And now we keep the tape rolling to hear from Graham and his guest as they reflect on their discussion and anything they wanted to add.
Is there anything that we missed? Anything that you would like to expand on? Anything you'd like to clarify?
Yeah, I mean, I guess I think active management could be talked about a little more as opposed to passive. And it's been
okay. Expand on that now.
Yes. I believe that ESG investment is very much an integral part of active management.
Okay.
All active management should have ESG. That part is easy. But all ESG thus far has not been actively managed. A lot of it has been done passively. And I think that that is a disservice, because if you look at the way the market indices have played out, they are exceptionally concentrated in a small group of technology names that are highly concentrated and vulnerable to the same risks, all of them, and regulation, etc. And so, because ESG is a dynamic space, active investing and activist or active ownership, engaged investing, are critical to its success. And so, looking for the least expensive way to satisfy or check a box on I have an ESG investing, I think does a disservice to the space. That is my one concern, both with the greenwashing as well as the passive process of investing.
And,
Because if the benchmark's goal is to match a past that we think we leave behind as we move into ESG, right? So it's a contradiction in terms. I used to say that if you're an alien from space and you came on Earth and you saw 80% weeds and 20% water lilies, are you going to make a bouquet for your sweetheart that is 80-20 weeds to water lilies, or are you going to make just water lilies? No. So I like to be in the business of picking water lilies instead of making this a cross section that looks just like the market.
I wonder if any of those overarching investment industry initiatives like the High Meadows Institute or one of those think tanky type things, I wonder if they've thought of how would you redesign a benchmark index where you had reweighted or revalued to better include those externalities. And you reweighted it that way. I've never seen anyone that's done to that level of kind of with that intellectual underpin, but then executed in some useful way yet.
Yeah, people have tried to create, but those are actively created passive portfolios.
Right.
That's when you say index, you mean one conventionally means the market weighted opportunity set of firms out there, right? And that is presumed to have efficiency, etc. It was fit for purpose at a time. I just think it's irrelevant at a time of great change. I've long believed that the past has never been less relevant to our future than it is now, because we are at that pivotal moment when we are going to have to make some dramatic changes. And so holding ourselves weighted down by what the past has brought us to seems like the antithesis of what you're trying to do, right?
Yeah. So two pieces from my side then to check on. An ETF, right? An exchange traded fund. For me, I like it because it's low cost and it's useful for a large amount of people, right?
Yeah.
It's like a default, just at least be investing in something.
Yes.
Something in the market, right? But then ETFs themselves, there's been sophistication. Now you have the ANT, actively managed non-transparent ETF, for example. So understanding you're an active shop, but is there any way you could get a vehicle like an ETF where people who don't have 3 million or whatever your threshold is to invest in your SMAs, they could access it without kind of the costs or, one would argue some of the administrative lack of a mutual fund?
Absolutely. Because now you're talking about how the wine is bottled, right? Should it be in a large bottle, small one, or a glass? And I'm saying, yes, of course. But it's not by definition that an ETF is, when I say indexation, I mean, however delivered, absolutely. We are looking into ETFs as a cost-effective and accessible model. And, over time, I hope that we've certainly added mutual fund sub-advisory role to our capabilities, and my hope is we'll continue on that journey.
Excellent.
As the technology on the ETF side improves. And
excellent. And then, to your point around the past has never been less helpful, and so other asset classes, right? So if you are taking a long-term view, you are concentrated. For me, you're getting closer and closer in kind of culture and philosophy to private equity, right? To private equity model 2, growth equity, not financial engineering model 1, but model 2, common in emerging markets, what I'm familiar with and worked with, where you've got a 10-year horizon, maybe plus one, 12-year total horizon. So have you looked at model 2 private equity, growth equity as an asset class you could take your strategy and execute in that way?
We haven't, but I would argue that a lot of what we do in the public markets looks a lot like that, in the sense that we are thinking very long term and we have best and worst case scenarios, and we are looking to own and engage and improve, all of which are attributes of that. But no, we haven't done the private equity. If anything, we might be looking at, other ways to have impact, perhaps within the to have income with impact, for example, and so on. Yeah, but we haven't yet looked at private equity.
Wonderful. Well, once again, an excellent interview. I really enjoyed the conversation I had with Geeta. She's a really good sport, and it was wonderful to enjoy the uplift of her thinking and her appreciation for the work that she does, and her worldview, which I can relate to as well, being born in a different continent, different country, and then living and working now in the US. I really respect the fact that she started her own shop from scratch. So one client at a time, one first call at a time, one investment committee meeting at a time. She's built up her team, and now managing a successful small shop. $4 billion is solid work, and in that, she was a board member of the PRI. She's won the Joan Bavaria Award for the leadership she's shown in the industry here in the US. But appreciating the effort and the kind of long-term thinking. Her kids are older now, much older than mine, but you can almost hear in the way she's taken on her writing project, where she's writing these short notes, and hopefully there'll be a manuscript soon, where she's reflecting on the ground that she's covered and how they've done what they've done over time, and where that's led her in terms of her view of the world, her thinking of how the world is and how it could be better. You heard a frank reflection on the tragedy of the horizons question, this David Attenborough question, where we look at the S&P 500 and the size of the climate pollution problem, as well as the population size. You hear her reflect on kind of the explosion of all three of those in terms of more humans, the run up in terms of market cap, the size of the investable market, as well as the climate pollution and what that says about who gets to decide and how much of how life happens nowadays is modeled for those who are rich. And candidly, that not everyone who aspires to live like that can live like that, because we don't have enough earths for that to play forward. I appreciated that she had the personal connection to some of my journey, both the divestment movement around apartheid South Africa through the late 80s was a significant part of her first exposure to ESG, kind of flipping her onto that. And then fast forward all the way to her reflection on top 100 moments in the history of ESG. She would include Bill McKibben and what he's done around the divestment movement, how influential that has been, the divestment from fossil fuels. And I found that a neat way of kind of connecting my South Africa and Vermont worlds. Geeta also makes some powerful points around the importance of investing for the long term. And she is frank that we, in some ways, are already maybe past just looking at sustainability, just integrating ESG. And I've been thinking about this a lot lately. Maybe you have too. Just in some ways, we're 10 or 20 years too late to just kind of turn things around, just adding in ESG now. Now we really have to think, as she says, in terms of regenerative investing. We have to really re-engineer and upgrade and rethink the whole investment practice. Some powerful words there, and I'm hoping that comes through in her book, and maybe have a look at her Joan Bavaria Award speech, which she considers still relevant, especially her comments around the CFA Institute and how it is or is not teaching the next generation of investment practitioners on environmental, social, and governance factors, or in fact that climate is a meta theme that is overshadowing all other strategies of portfolio companies or securities one might invest in or value. I will reflect more on that as I do the CFA ESG certificate as part of my own kind of updating and refreshing and figuring out what is being put in the hands of investment practitioners as I prepare to be teaching again now too. I appreciated also she was very clear, and we could kind of connect on that, the role of humans, that the execution of any business model relies on humans and the importance of growing the pie and making it better. That connects directly with that framing that I often use, that ESG is implicit in every investment decision, because every investment decision happens on planet Earth and relies on humans to make, do, or buy stuff, and on the rule of law to protect minority investors and the relationships between humans and between businesses. So ESG is implicit, and I really appreciate her focus on the humans that are part of the society and make the economy possible. Of course, she was going to be a global news junkie, so I appreciated that, as well as her book pick around homegoing. That's heavy reading, but I've added that to my reading list. Maybe you will too. I really enjoyed the video moment she offered up, the Gordon Gekko speech. I've used it in my lectures about a decade ago when I first was teaching MBAs on sustainable investing, and I'll use it again. And I will include the show notes, the comment from Oliver Stone, the director, and how he initially thought that speech would see Gordon Gekko seen as a misanthropist and an anti-hero, but instead was interpreted by a whole generation of wannabe financial bros and Wall Street types as kind of the guy to be. Funny how things work out like that. And a reminder how powerful fiction can be and how powerful movies and video moments can be, which is why it finds its way into the ESG and Coffee podcast. I also appreciate the years of experience, and you can almost hear the pain and the suffering that Geeta must have had through years and years of investment pitches when she spoke about the myths of rebutting that just because you're integrating ESG factors, you create underperformance or a shrunken universe, and how she's in fact reformatted that. And it's very clear that making the investment case without ESG factors is actually the poorer or the suboptimal approach to investing. And I appreciate also she talked us through her reasoning on a few portfolio names, Citi, and where she's taking them in terms of the PCAF, the portfolio carbon framework that's being implemented, Weyerhaeuser and the sustainable forestry, and Kroger with the diversity concerns and the availability of retail to different market segments. I heard very clearly, and hopefully you did too, the urgency in which we need to move to decarbonize what we're doing. And finally, I appreciated her reflection on how integral shareholder engagement and activism is to the work of Boston Carbon Asset Management, and how she has a business model around that, and how she's happy that they can catalyze other larger investors and collaborate and so on through initiatives like the Climate Action 100 or the Principles for Responsible Investment. And she's very comfortable that that's going to take some of their effort and their intellectual bandwidth and some cash from the business to make happen, but that's critical to doing their job well, which I really appreciated. I am now 4 for 4 in terms of interviews, in terms of investment managers or investors not having a crisp or best example answer to my question on what is the shadow price for CO2 equivalents per ton that you have in your portfolio. I appreciate that Boston Carbon Asset Management is tracking theirs, and I appreciate her humility in kind of taking on board my suggestion that is implicit in the question, offering up as ESG architect how they could think about doing that at the shop level, but also what they could do into their portfolios. And at the end, of course, we have the opportunity to meet with her again sometime in a future episode of ESG and Coffee. She has so much experience and so much that she can share, and I do look forward to having her back in a future season. So with that, thank you again for listening, and I look forward to sharing our next investor guest with you shortly. Please do give us a 5-star review if you like what you heard on your favorite podcast app. Hit us up on Twitter at ESG and Coffee for more news on the podcast, and to let us know what guests you'd like to hear from in our long-form interviews. Thank you so much for listening.
We hope you enjoyed the interview with one of the originals in investing, strategy, and sustainability. Please subscribe on your favorite podcasting platform or on YouTube and leave a 5-star review. Bad reviews you can send to Graham Sinclair at ESG Architect. All the details are in the show notes. And for news of our next guests, follow us on Twitter or Instagram at ESG and Coffee. Do you know an impressive human we should absolutely interview on investment strategy and sustainability? Please let us know on Twitter at ESG and Coffee. Our producer is Kat Farquharson on Twitter at Kat Farquharson, and original music by Aaron Bonney on Twitter at Aaron Bonney Music. And of course, this podcast is for your enlightenment, not investment advice. Do your own research.
You have been listening to the ESG and Coffee podcast on investing, strategy, and sustainability, hosted by Graham Sinclair.